Hey, what's up guys? Welcome to the Market Board. My name is Dave and today we're going to start a brand new series, my super simplified stock series. Let me first start off by saying right off the bat, I am not a financial advisor, but rather I am an individual investor. My goal is just to break down some of this jargon-filled language and make it understandable. I figure where better to start than the actual beginning with what is a stock. A stock is a unit of ownership in a company. Basically, if you own a stock, that makes you a shareholder, meaning that you may be eligible for some earnings if the company succeeds, and you may have a vote in some company decisions. You might not have much of an impact, but basically, you're now an official business owner. What do I mean by that? Well, if a company has 100 shares of stock outstanding, and you own one share, that means you own 1% of that company. The value of your shares will represent approximately the percentage, 1%, of the company's market capitalization or the value of all outstanding shares. So basically, if that company is worth $100 million and you own 1% of it, you have $1 million. That's really all there is to it. So why do companies even offer stock? Imagine that you want to start your own business, but you only had $10,000 to start. In order to buy the necessary supplies, property, equipment, and etc., you might have to raise money from friends and family. Let's pretend that you had 4 friends and that each of them were willing to give you $10,000. You now have $50,000 total and you're able to get the business off the ground. In exchange for their investment, you might agree to give each of them 20% of the business and its profits. This is kind of how the stock market works, except times like a couple hundred million. Generally speaking, the reason you release stock is to raise capital. Something to note is that the stock market is actually a broad terminology that encompasses a collection of markets, and while it's called the stock market or the equity market, other financial instruments such as bonds, commodities, currencies, and even derivatives like options are also all traded on the stock market. So basically, it's just a massive umbrella term to act as a barrier to keep you out. Some of the most well-known stock exchanges in the United States include the New York Stock Exchange, the NASDAQ, the Better Alternative Trading System, and the Chicago Board Options Exchange. Before we move on and cover the different types of stocks, if you're looking for a great free resource for stock due diligence, check out my playlist. I don't even try to sell you a premium course, trick set, or a magic kit. Seriously, check it out. It's entirely free. But moving back on, we ask what are the different types of stocks? First off, there's common stock and there's preferred stock. Starting with common stock, the more common of the two. The major key benefit of common stock is you get voting rights in corporate actions, such as electing board of directors, establishing corporate objectives, and even participating in stock splits. Each share typically equates to 1 vote. On the other hand, with preferred stock, this is typically for investors who do not need to vote on corporate issues and are interested in receiving a higher dividend and a higher claim to assets in the case of liquidation. Let's now use this opportunity to cover some of the common stock terms that you probably see on your popular platforms, including Reddit, Twitter, and StockTwits. A broker is someone who executes trades on the behalf of an investor/trader, and often they receive a commission in return. A stock, as you already know, of course, is a unit of ownership in a company. The share price is what you are paying per unit of ownership. The market capitalization is the total number of shares times the share price, and that gives you your company value basically. Short selling has been big in the news, so let's cover it here. When an investor wishes to speculate on the fall in a stock price, they can short a position. This requires borrowing the stock from either a broker or a financial institution, and ideally, in their world, they would buy it back at a lower price, and the difference is the profit minus any fees they pay. On that note, let's lump in short interest, which would be the total number of shares actively being shorted. Margin trading, you've probably seen that on Wall Street Bets, is buying securities with the broker's money. It is very, very risky, and I never recommend it to anyone else, but I do it myself. A penny stock typically refers to a stock of a small company that trades for less than $5 a share. Some of these are on large exchanges, however most are over the counter. Pink sheet stocks, they're probably dog shit. Over the counter refers to the process of how securities are traded via a broker-dealer network as opposed to being on a centralized exchange. So now let's take this opportunity here to recap all of the basics. By owning a share, you more or less become a business owner. My approach to the market is simply this. Rather than trying to flip trendy tickers or the next meme stock, I buy small portions of ownership into great companies and great opportunities, and ideally, my portfolio will grow alongside them. I always do keep an eye open though for new opportunities, but just remember guys, don't chase the money, that's gonna make it run away faster. If you have a different method and you want to talk to me about it, let me know down in the comments below. But just as one final reminder to everybody, I am an individual investor. I am not a financial advisor. This should definitely not be considered financial advice. My name is Dave, and this has been The Market Board.